Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. I've titled this video, Which Cash Secured Put Strike Should I Use? Today's question comes from David. Hello, Alan. I've been selling weekly cash secured puts, seeking weekly returns between 1/2 and 1%. I want to avoid having to buy the shares. Today, MRVL Marvel is priced at $90.21, and the 92 strike yields $5.40, but it is at risk of exercise. The 79 strike yields only 74 cents, but is less likely to be exercised. I also noticed that the implied volatility of MRVL is pretty high, 84.4%. Can you help me with the math as how to choose between these two? Thanks, and it's signed David. Okay, strike selection for cash secured puts. David, let's start by defining the strategy selling cash secured puts. This is where we sell the put buyer the right, but not the obligation, to sell their shares to us at a price that we determine, which is the strike price, by a date that we determine, which is the expiration date. Now, in return for undertaking this contractual obligation, we are paid the put premium. Now, to make it cash secured, the broker is going to require us to place a certain amount of cash into our brokerage account in case that put is exercised and we are forced to purchase the shares. Here's the formula to determine how much cash we must put into our brokerage account. We take the put strike and deduct from that the put premium and multiply that by 100 for one contract. Now, if we sell more than one contract, we take that number and multiply it by the number of contracts that we're selling. And that will determine the amount of cash necessary to secure that put sale. Okay, let's get to this real life example now with Marvel Technology. Once again, listed on NASDAQ MRVL. On 11/27/24, Marvel was trading at $90.21, as David stated in his question. Now, the 12/6 in the money 92 strike, in the money for puts, is higher than current market value. And that had a bid price of $5.40, looking pretty robust. On that same day, 11/27/24, the out of the money, lower than current market value, 79 strike, had a bid price of 74 cents. Is that enough to meet David's goal of 0.5% to 1% a week? Well, we'll soon find out. Okay, let's now talk about David's comment regarding the implied volatility of Marvel at 84.4%. Now, what's the first thing we think about when a particular stock has a very, very high implied volatility? Well, the first thing I think about is earnings dates. Now, it could be that that's just a high IV stock in general. But the first thing I look at is to see if there's an upcoming earnings report during that particular contract. Because what happens with earnings reports, there's a lot of speculation as to whether it's going to beat, miss, and so there could be a huge change in the price of that underlying security, and therefore traders are willing to spend more money for that particular option. So I did check earningswhispers.com, and there's a screenshot of what I found in this particular PowerPoint slide. And you could see that the red arrow on the bottom left, that Marvel was due to report on December 3rd after the market closed, which was within that contract cycle of 11/27 to 12/6. So yes, that's one of the reasons why the implied volatility of 84.4 was so high, because of the speculation around the earnings release. All right, so right away, that makes it a risky trade, and I would just avoid the trade altogether until the earnings report passes. But we move on. Let's talk now about delta. Now, delta actually has three different definitions. The one that applies to David's question is the approximate probability of the strike expiring in the money, which means with intrinsic value. Now, that's something that David did not want, because if it's expiring in the money, then it becomes subject to exercise. And to avoid exercise, we'd have to use some exit strategy mitigation. All right, so we looked up the delta for the in the money 92 strike, and as expected, the delta was much higher than that of the 79 strike. So the delta for the 92 strike is 53%, meaning that there's approximately a 53% probability of the 92 strike expiring in the money by expiration and therefore subject to exercise. Not good for David's stated goals. Now, the 79 out of the money strike, on the other hand, had a delta of 13%, which means that there's approximately an 87% probability that that strike will not expire in the money and therefore will not be subject to exercise. So that seems a lot more appropriate for what David's stated goals are. But is the premium going to meet his 0.5% to 1% a week? We're going to find out starting with the next slide. Now, just as an aside, delta, when you look it up on various option chains, is published with a minus sign. And the reason for that is that the delta, the premium for puts, is inversely related to the movement of the underlying security. So if the stock price moves up, put premium value goes down and vice versa. And that's why when you look up delta for puts, you'll see a minus sign in front of the value. So low deltas are much more appropriate in David's case because he is looking to avoid exercise, which most put sellers are. There are some exceptions, but basically what you want to do is you want to look for low delta strike prices. So the 92 strike, the takeaway from all this with delta is that the 92 strike is not appropriate for David's particular strategy goals. So let's look at the out of the money 79 strike price. So let's feed that into the BCI trade management calculator, keeping in mind that David's goal was a 0.5% to 1% per week. So we enter into the TMC, the price of Marvel at 90.21, the out of the money 79 strike at 74 cents. Here's what the spreadsheet tells us, that if taken through expiration, okay, it's 10 days, the trade, so it's like a week and a half, and the time value was 74 cents. Now that converts, if you look at the red arrow, to 0.95% for that time frame, and that annualizes out to 34.5%. Well, if David's goal was a 0.5% a week, that's 26% annualized. 1% a week is 52% annualized, and this trade actually falls out in between at 34.5%. So that does in fact meet David's stated goal, and again an 87% approximate probability of not expiring in the money or subject to exercise. Now, what if the price of Marvel does in fact drop below that 79 strike and we take no action to buy back the put? Well, then we will purchase Marvel at the break-even price point of 78.26, you see in that yellow cell, which represents a discount of 13.25% in the purple cell from the price of Marvel at the time the put trade was entered, which was $90.21. So if we were to summarize everything now, when you're selling cash secured puts with two specific objectives, one, a time value return range of a 0.5% to 1% a week, and to avoid exercise and having the shares put to us, well, we want to avoid in the money or high delta strike prices. Okay, we want to stick basically to out of the money strikes. But if that strike is expiring in the money as we approach 4 p.m. Eastern time on expiration Friday, we need to be prepared to buy back that short put, and that will avoid exercise. Problem solved. Now, we should also avoid the risk of earnings reports. You saw the very high 84% implied volatility. We don't want to add risk to these low risk strategies. And finally, we use our BCI Trade Management Calculator, or TMC, to get accurate initial time value calculations to see if that particular strike is going to meet our pre-stated initial time value return goal range. Okay, so as I always do, would you like to master the strategies of covered call writing and selling cash secured puts? I hope you do. Go to our store. There's a drop down for best packages and build your own toolkit. Under the best packages link, you will see 3 packages. The first one is the BCI package, our best and most comprehensive investment package. There are 18 components, 6 online video courses, 6 spreadsheets developed by BCI, 5 of our best-selling books in ebook format, and most importantly, our 13-month annual premium membership. We have access to all the reports of eligible option selling candidates, over 250 training videos, and dozens of downloads and worksheets. The second of our best discounted packages is our trade management calculator package. You saw this TMC in action in this particular video. That spreadsheet is an absolute must for anyone using these strategies. And it comes with that spreadsheet, its 28-page user guide, and a PDF version of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. That's 27 chapters of exit strategy information. The third of our best discounted packages is our CEO package, which is an acronym for combining exchange traded funds with stock options. It's a streamlined approach to covered call writing for those of us with busy schedules. You still want to generate cash flow that beats the market, but you want to do it in a much more time-friendly manner and user-friendly way. And that is a strategy which I think would align with this particular strategy, where you're using only 11 select sector spiders as underlying securities. So for that, you're going to get 2 worksheets that we develop, one to help us set up our portfolios and the other to archive our results and compare it to that of the S&P 500. Also comes with a PDF of my 9th book, Covered Call Writing, a streamlined approach. Now, if you go to our CEO package and you look at the videos and information, you can combine the basic CEO package with the trade management calculator package, or you can get all these packages combined into one package, the CEO total package, which then you'll have absolutely everything that BCI has to offer. You can also go to our store and build your own toolkit and get items individually. And ladies and gentlemen, that ends this Ask Alan video number 231. David, thank you very, very much for asking this question and allowing me to share this information with the entire BCI community. And I also want to thank everybody who took the time to listen to and watch this Ask Alan video. Folks, I hope you enjoyed this video, but most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.